So my name is DJ McClure. I'm the Vice President of Business Development here at National Flood Experts. I've been with the company for right at 5 years. It's been quite a journey, and it's been a huge privilege to get to have worked with as many different real estate professionals as we have. So if you've never heard of us, National Flood Experts, we're the leading engineering firm providing cost-saving solutions all over the country. We find millions of dollars in savings every year. And education is a huge focus of ours and something that we really love putting forward. So just a few highlights about us. We've made the Inc. 5000 for the last few years, so that's something that we're very proud of. And having done over 3,000 projects, we're really looking forward to what we can continue doing with clients in the future. So just a quick agenda for today. You'll see there's several things that we'll be going over, talking about risk rating 2.0 and how things have changed from previously to now, getting into how you can use some of this information for buying properties, how you can unlock some financial performance within some of your current properties, and then how you can maximize value into some properties that you may be looking to refi or sell in the future. All right, so let's jump into something that's been a huge part of the flood industry in the last 2 years with the evolution of the National Flood Insurance Program, Risk Rating 2.0, you've probably heard it called. I thought this was a pretty fitting slide here with some of the turbulence that we've seen in the evolution. So let's talk about what are some of the differences. If you're familiar with flood insurance in any regard, there's a number of factors that they've always used for compiling the flood policy. So with the old system versus the new system, we'll jump to that on the next slide. There was a combination of things that changed. Simply said, there were variables in the old system that had, much higher weight and much higher multipliers in terms of how the premiums were calculated. So with the new system, you're seeing new things that you didn't see before, like the replacement cost value. This is something that's been introduced and has had, quite an impact within certain types of properties around the country. Some of your same details carried through, building demographics, number of floors, square footage, etc. But something that's been really interesting with the new system is, if you recall, if you've ever bought a property in a flood zone, an elevation certificate was required for all newer properties. And so with the new system, they actually have instituted to where FEMA has some estimations that they're able to make. And so an elevation certificate is not required to get a modern day NFIP policy. Kind of been a bit of a misconception in something that we hear quite often. But it's one thing that's somewhat nice in the sense that it at least won't slow down the process. If you're ever buying a property and you need to get a quote quickly, not having the elevation certificate in the past could be quite a delay. Now, in some situations, you may be wondering, well, does the elevation certificate make it better or worse? And the answer to that question is, it depends. In some situations, you may find that the data doesn't even make a difference. And that's because FEMA may think in their rating system that the estimations they're making are actually more favorable. Now, there's some other things that you'll find in the new system where they're using the latitude and the longitude of the properties from a geolocation standpoint. And what that means is that they're using this latitude and longitude on the property to measure distance to water, things like that. And then you also have carrying over the occupancy type. So is it a duplex? Is it a 5-unit multifamily building? Is it an elevated building, etc.? Now, there's lots of these different variables. This isn't necessarily the entire list, but these are some of the things that you'll see commonly talked about as you're looking at a property. Now, as we dig into, specifically the old versus the new. So I have a couple examples here to show you just from the declaration page of a couple sample properties. So this first example that we're looking at, this is the old system. This is a 1.0 declarations page. You can see on here, there's quite a few details. It's a 2 to 4 family, meaning it, is a 2, 3, or 4 unit type building. You can see here that it's in an AE flood zone. and it's non-elevated. So in the past, you could look at some of these details and you could estimate pretty closely to what you thought their premium might be for this particular type of building. Now with the new system, you're seeing that they're introducing some of these new variables that we were talking about. You can see this particular building's other residential, meaning that it may have 5 or more units. We can see this one has a basement, 1 floor. We can see here the replacement cost value listed at 1.2 million. Now that might not at just first glance really mean anything, but when policies transferred from the old system to the new system, one thing that insurance brokers were forced to do was to go in and manually update all of these details. And 1.2 million was the assumption that was placed on a building if an updated replacement cost value was not input into the property or into the policy. Now, where does that have any kind of impact here? Well, if the replacement cost of the building is actually less, that could potentially lower the premium by a certain percentage. If the replacement cost is higher, that could also impact the percentage of, or excuse me, the price of the premium. Now, this isn't to say that any one of these variables is going to have a huge multiplier. That's what's really difficult about the new system, is that it's not quite as predictable as it was in the old 1.0 NFIP. Now, let me bring attention to a couple things here. In the old system, you had certain multipliers that were essentially what was really moving the jumping of the premium costs. So here being that this is in an AE flood zone with an elevation difference of 0, meaning that the first floor of the building is within a ½ foot of the flood zone elevation. This particular premium here being 2 to 4 family, that means that it would only receive 250,000 of coverage, whereas other residential and commercial buildings can receive up to 500,000. So in the old system, you could look at these couple of variables here and you could estimate pretty closely what the premium cost for that building might be. Whereas with the new system, we're saying, okay, it's got a replacement cost value. FEMA estimated that the first floor height would be 1 foot. And again, with some of these other factors. So with this, it'd be very difficult to then estimate as a buyer or as a property owner what this premium might be. Now, something that's brand new within Risk Rating 2.0, and this is something that I really think if you're taking notes, this is one of the pieces you want to really take a few notes about, is the introduction of the full risk premium. So in the past, if you had an NFIP premium, you really didn't have any idea of what the ceiling price would be. Meaning that if in the springtime when NFIP would introduce their premium increases for the year, if your particular type of policy was receiving a 10% increase, then you'd increase 10%. With the introduction of the full risk premium, we now know what the ceiling price of your policy will be. So as we're looking at this policy here, you can see this is a 500,000 coverage policy. And you can see the premium that they're actually paying down here is 1,352. Not entirely unreasonable for that level of coverage. Now, something that's interesting about this policy is if you actually look at what the full risk premium is, it's just over 4,000. Now, what does that mean? Well, if someone's paying 1,352 today, this means that FEMA thinks that the actual premium, the real premium of their policy is just $4,253. So that means that this policy is going to continue increasing every single year until it reaches that full risk premium. Now you can see here, there's this annual increase cap discount. And this is the discount that they're receiving as of the policy today. So every year that discount is going to decrease. So what does that look like from an ownership perspective? Well, currently FEMA has an increased cap set at 18%, meaning that this 1352 could only increase 18% every year. And it's going to continue doing so. You can see on the graph here that over the next 5 years, that policy is essentially going to almost double. Now, it's going to take several years before they reach that $4,253 number. But here's an interesting detail to also take note. If someone were to come in and buy this building as brand new, and then go to their insurance broker and ask for a new NFIP policy, they would actually start at this $4,253 number from day one. Now, it would be fairly flat in terms of the years following and the increases they would expect, but nonetheless, you could see that's quite a dramatic difference. Now, if this particular property has several buildings, from an underwriting perspective as an investor, that's quite a different ball game versus this 1352. Now, we'll talk about on one of the later slides how, as a buyer, you could potentially take advantage of this current day premium number rather than having to start at the full risk. So you're probably asking yourself, where do we go from here? This is quite a bit of information and understanding the construction of a flood insurance policy, maybe a little bit more than you wanted to know. But essentially, we've got two options, right? So as a buyer, if I'm an investor, I'm going to go buy a piece of real estate. I have two options in terms of acquiring flood insurance. Now, as we've been talking about with Risk Rating 2.0 and NFIP, we do know that the premiums can be a bit now unpredictable. When your insurance broker goes to quote the policy, it's very tough for them to, on the front end, give you any kind of estimation without having run a quote. Now, that being said, though it may be unpredictable premiums at the initial quote, we do know with the full risk premium how much we can forecast the increases. So this is why it's so important to understand your full risk premium, because at least you know what the trajectory of your policy is going to be. If this other policy being at 1352, if it had only had a full risk premium of say 1500, you'd know that policy is not going to change quite dramatically over the subsequent years. With NFIP, you cannot be non-renewed in 99% of cases. So you can, as an investor in your business plan, you can know more or less what your flood insurance price is going to be for the subsequent years. Now, you have the private market. Private market insurance is an investment just like anything else, so they tend to hold all the cards. So if NFIP has a pretty expensive policy and you do find a more appetizing premium costs in the private market, a lot of companies we're seeing will give a great introductory price in year one, but since the private market doesn't have a full risk premium like NFIP, you really have no idea what the subsequent years are going to look like. And so have a current example just to share. This is a client that I'm actually in conversation with on a map amendment project. And he called me yesterday and said, hey, we're renewing in 2 weeks and our new policy is going to be just over 60,000. Now, I couldn't remember offhand exactly what his prior year policy was. So I pulled it up and he was only paying 25,000 last year. So that's a huge and dramatic increase. Whereas had he been with NFIP, we know that his increase would have only been 18%, which is still a large number. But this is something that you have to be mindful of, and these are conversations to be had with your broker, and just knowing what some of the potential outcomes could be. It's not right or wrong. It's just knowing and understanding what the subsequent years could look like. All right, so let's talk about acquisition. You're in the market, you're looking to buy a piece of real estate. Let's talk about flood zones. So this is something that, is a common questions that we receive. What are the different types of flood zones and really what do they mean? So you have various categories of flood zones. On the surface, you primarily have A and V flood zones, and then you have the X zones. The A flood zones are what you see most commonly around the country. This is typically what you see inland, around rivers, creeks, streams, lakes. And then the V zones are what you see in your coastal areas. You're only going to see these typically around, their outer brims, the coastal areas of areas that you might expect. But there are flood zones everywhere. You're going to find them in all 50 states. X zones are the 500 year and beyond. And so you're going to see that anything in an A or V, just to transition to the next point, is going to prompt a lender to require flood insurance. So you're asking, okay, well, what's going to cause a lender to require flood insurance? Well, legally, any type of federally backed loan is required by law to pass on the flood insurance requirement to the buyer. Otherwise, the lenders will be actually fined in their own right for not having proof of coverage if they were audited. And just to give you context, over the last 3 years, lending institutions were fined more than 15 million for not having proof of flood insurance correctly on a lot of their properties. So if you're ever wondering why they tend to be a little more conservative, this tends to be the reason why. So when you're going through the acquisitions process, a flood zone determination will be run in every real estate transaction, regardless of what type of flood zone it may be in. That particular document is going to say, is the property in an A or V flood zone, meaning flood insurance is required, or is it in an X zone where it's not required? It's really that black and white. And so if that document were to mistakenly flag a building as being in an A flood zone, for example, then your lender will pass on that requirement to you. And the thing about it is, no one really knows if that flood zone determination is 100% accurate, because there's nobody necessarily looking at all those in every single case. Now, in terms of types of lender requirements, this is something also that if you're taking notes, I would also write this down. In more traditional lending programs, whether it be a short-term bridge loan, for example, these are typically where you're going to see that just that 500,000 per building is being required for commercial, 250,000 if it's a single family home. And that's typically all you're going to be required to bring to closing. Now, there are situations, if it's in the private market, they can obviously set their own terms. But then back to the federally backed loans, anything that is then with agency debt, Fannie Mae, Freddie Mac type programs, they will want much higher limits. Could be as much as the replacement cost value, business income, et cetera. We'll dig back into this again on a later slide, but understanding why these types of requirements exist is really the base. Now, some common misconceptions, these are things that we see often that I like to pass on and just bring some attention to, really the difference between 100 and 500 year flood zone. So understanding that anything in a 100-year flood zone, this is what's going to be required for flood insurance. So on the left here, these A and V flood zones, these are the 100-year flood zones. Now, you don't want to read into this term literally. So it's just kind of an antiquated term that's been used to describe flood zones for quite some time. Anything in the 500-year flood zones, if you've ever seen a flood map, this will be kind of the orange area on a map, or it may not have any color at all. The 100-year flood zones on a flood map, these are going to be the blue areas, just in case you've ever looked up your own property. I encourage acquisition agents to pull up their property on the flood map, be familiar with learning how to research this and how to pull it up. We'll share a link in the follow-up so that you'll have access to that going forward. Something else that comes up in conversation a lot, and I think this is something that not is as commonly known as it should be, is that flood policies can actually change ownership at the sale of a property. Now, this can only really happen with NFIP policies, where you can actually change the ownership from the seller to the buyer, assuming that your broker has access to that particular carrier. But if you recall back to the example we were talking about, whereas that property was 1352 and the full risk was over 4,000, if the buyer has a chance to assume the seller's policy, they're able to then start at that 1352 price point as opposed to starting at 4,000. Now, you can do some quick math, especially if there's multiple buildings. That's quite a dramatic difference. So I encourage this to be something that you at least talk about with your broker as you're going through the acquisition process. It may or may not be a solution that works for you, but it's something to at least potentially look into. And then something else that we often hear, and it's because during the buying process, the lenders are so adamant about all the different requirements that you have to go to closing. I don't have to tell you, you understand how difficult it is to get to the finish line of a deal. And so it's obviously easily understandable as to why people wouldn't think that the lenders would then drop the requirement. But again, back to the flood zone determination document that the third parties are running before closing, if the flood zone determination were to be updated for any reason, be that the flood map changed because the county updated their local maps, or for any other reason where the flood zone determination now shows the property as X, the flood insurance requirement will no longer be in place. Now, again, as we're going through, if you have questions, please go ahead and drop those in the Q&A. I'll be coming back to those as we get into the second half of the presentation. So for all you guys that have deals currently in flood zones or may know someone with a property in a flood zone currently, how can we unlock some additional financial performance currently, right? So a couple strategies that we have at hand, right? Well, understanding that flood zones can be changed, right? Like I was saying before, sometimes your county might be doing a flood map update. You want to know that flood maps really only change about every 15 years in most parts of the country. We still see the occasional map, honestly, from the 1980s or 90s in some more rural areas of the country, surprisingly. But it does happen. And so if you're buying a property in a flood zone and there is an old flood insurance map, it is worth having a professional review that to see if a letter of map amendment may be possible. Now, this is something that if you're in a flood zone, I encourage every property owner to have someone evaluate if this might be possible. A letter of map amendment is FEMA's way of acknowledging that the flood maps aren't perfect. So for individual buildings, they can actually be taken out of the flood zone and changed from an A or V, more commonly an A, into an X zone. And so a letter of map amendment is a federal document that's introduced as a case number. It's unique to the legal description of the building, and it will actually live with the property, meaning that as long as the LOMA is valid, that particular building is going to be considered the X zone. And as we learned a couple slides ago, anything in an X zone is not going to be required for flood insurance. Now, that's not to say that you still cannot buy flood insurance. You absolutely still can. It's to say that you no longer have a lender that's dictating what the terms are. Now, as we're talking about, all right, maybe the letter of map amendment's not possible for your property. And that tends to be the case. It's not every single property that can be changed into an X zone, but there are ways that you might be able to lower your flood insurance today. So again, all those factors that we talked about a couple slides ago, with the new risk rating 2.0, they've really spread out the multipliers across a lot of different details. In the systems of years past, there were a couple of variables that had the biggest impact. So if the flood zone changed, your policy could reduce by more than 50%. Unfortunately, that's not the case with the current system today. But in looking at all those different variables, if any of them or a combination of them can be improved in any particular way, there is then a chance that the premium would be lowered. But more importantly, we're seeing a lot of cases to where when some of those variables have been corrected, the full risk premium is then lowered. And if you remember that graph that I showed you where the policy was going to double every 5 years, it would totally change the trajectory of the next several years. Because if the full risk premium is reduced, then that's also going to reduce the increases that you're seeing year over year. So this can be massive. Now, let's talk about, this is a team approach. I'm a big proponent of this. We have great relationships with insurance brokers all over the country, and it's important that we're all on the same team. So we all have the same goal at the end of the day, and we all want to see property owners and investors be able to get the maximum valuations for their property. And so how does the insurance broker, really fit into the equation? Well, we're a team. And so working together, the broker obviously has their expertise. And then as you're introducing perhaps engineers or experts into the equation, we're looking at all the variables. And so your broker may have options into looking into the private market. They may have different ways that they can leverage, umbrella type master policies that also can help reduce your costs. But then, using some things that can help dig into some of the engineering variables like we're talking about, maybe a loan is possible, maybe some of the engineering details that are going into the policy can be improved. And then working together with the carrier, you're able to then get the premium or the full risk then reduced, and it becomes a huge win all around for everyone. Now, understanding the full risk premium, I think once you can get this information from the seller, if it's a buying situation or looking at, what it is currently on your property, understanding that number can really help affect your underwriting for the next several years. this may be able to make some dramatic differences as you're looking at maybe post refinance, or if it is a deal that you're looking to purchase, you can talk about this with your broker. You can figure out how you can use that information to be more powerful. Now, as you're working with your broker, I think it's important, if you're thinking about maybe selling a property in the future, well, maybe the property can be taken out of the flood zone. You may not change anything on your actual insurance. You might maintain your flood insurance policy just the same, but by having a letter of map amendment in place, that'll automatically transfer to a future buyer. So you're then able to recognize the property value increase because of the flood insurance no longer being a required cost. And you're also able to market the property as no longer being required for flood insurance. I would say, as we are, let me go ahead and launch the poll that I forgot to launch earlier. One of the main questions is, have you ever avoided buying a property in a flood zone simply for that reason? I would guess that many of you would say yes. So working with your real estate broker to help increase the buyer pool of people that might be interested in your deal could be a great way to maybe sell your property at a higher dollar amount. Now, on that same idea, as we transition, we're going to send a due diligence checklist out to everyone after the recording has been cleaned up. And so this is something that I think is really important to add to your checklist. I'm sure you have other things that you're looking at and evaluating your deals. But one point that I really want to take away from this slide is that the seller's situation is not always going to be your situation. As situations we hear quite often where someone will say, well, the seller told me the property is not in a flood zone. And what that means automatically in my mind when I hear that is that the seller may not have debt on their property. So just because they don't have a flood insurance policy doesn't automatically mean it's not in a flood zone. So we see situations all the time where we'll get a call a couple of weeks before closing saying, I just found out I have to get flood insurance. And somewhere along the process, it was missed by all the other parties involved that the property was actually in a 100-year flood zone. So something that's on our due diligence checklist is looking from square one, learning how to research the address, find out if it's in a 100-year flood zone, and then know from day one, okay, there's 4 buildings here. I need to make sure that I'm accounting for that in my underwriting for the property. And then oftentimes, the seller may not have every single policy, so learning how to ask all the right questions, get as much information as you can from the seller, and then you can start investigating if things like a policy assumption might be a possibility. You can really start to dig into the numbers with your broker and see, okay, what's the best option for me here? And then you can hopefully understand what your flood insurance costs beyond year 1 might be. Now, as a lot of you know, there's a lot of short-term debt that's going to be maturing here within the next 18 months. And so, refinances and, potentially some unexpected sales of properties is going to be imminent. We know this is coming. And so there's going to be a lot of people that are, refinancing into perhaps agency debt or trying to refinance into any kind of debt. And this is going to really be a topic of conversation. I think there's going to be a lot of people that had, just base level flood insurance requirements, like we were talking about, $500,000 per building. And as they transition into, agency debt, they're going to see that, well, now they have to cover the full replacement value. They've got to bring 12 months of business income to the equation. So if you had a property where maybe 10 buildings, 500,000, so they've got 5 million in coverage, but the Fannie Mae requirements may ask for 20 million in flood coverage. Well, what's that extra 15 million cost? I've seen scenarios where it could be anywhere from 50 to 100,000. So that can dramatically change the business plan for the subsequent years. In some cases, we've seen scenarios where the flood zones actually kind of killed the refi. So why not having a flood insurance requirement matters? Well, it may not change your day-to-day flood insurance, but it might prevent any kind of huge increase as you go into the refi. Now, on the flip side, we have cases where people have had huge flood insurance premiums, and then we're able to remove the requirement before going into the refinance, and it's dramatically increased their cash out value. We'll talk about a case study in a couple slides of that specific example. So it's great to have as much information pre-sale as well, because again, if you can do any of these things to help increase the marketability and increase the property value of the asset, it's going to help you in the negotiation of the sale. The flood zone is only one variable. There's obviously many, many others, but if the flood zone can be at least a positive piece of the transaction, then hopefully it's going to make that closing go through a lot more smoothly. So let's jump into some case studies. These are some great ways, I think, to kind of take some of this conceptual information and really kind of bring it all together. So pretty classic situation. This is actually someone that we've been working with for the past few weeks. They have a closing set for tomorrow. And so the property was reviewed by our engineers. We had a couple buildings that actually qualified from the information we had available. There were a few additional buildings that needed some new data and some additional on-site information that will then help qualify those 2 additional buildings. So these 5 buildings, they had, more than just the normal flood insurance requirements. So their quotes were coming in close to $50,000. They didn't really know this until honestly within the last few weeks. And so it's become quite a topic of conversation. They've decided to move forward. They're going to have the flood zone requirement removed post-closing, which in some cases we've worked with clients where you can actually have this done. It's going on in the background as you're finalizing all the lending pieces to where you're actually going to closing and FEMA has already approved the map amendment. In this case, and which is kind of common for a lot of our clients where they're actually waiting until closing to have this done. And so then it will be using, some expedited channels with FEMA to get this processed as quickly as possible. In some cases, you can have map amendments processed in just a matter of a few weeks, typically 6 weeks or less, even on the long side. For this particular client, and this represents almost $1 million in property value extra from day one. So this is a pretty dramatic win. And these are cases and scenarios that we really see all the time. And this is one of the cases where had they not actually had this recommended by their broker, that's who referred this project into us, had that not happened and they had gone into closing, it could have been potentially years before they learned that this was even possible. And obviously you can imagine this is going to make a dramatic increase in the NOI of their property from, day one forward. This is the case that we actually just did a video testimonial on our client on our website. You can go to our In the Zone section and you can listen to quite a few of our actual clients. They're only 3 to 4 minute testimonials, so they're quite quick. But this is a recent case from over the summer. We happened to work with this client, remove 12 buildings from the flood zone before they went into their refinance, and he told me that it amounted to an extra $600,000 in their cash out refi. So that's real money, as our clients like to say. And, this is a case where we're just able to reduce the premium. So that simply by itself created a massive valuation increase. I'm sure you can all relate to these kinds of cases and why this would be so exciting. And then a third case study that I wanted to share. I'm sure you've all heard of 84 Lumber, probably gone in, bought some for a backyard project at some point. One of our sales reps met the risk management at 84 Lumber probably over a year ago. And we ended up looking at just over 20 properties, as we went through their whole national portfolio. And you found a lot of properties just like the one you're looking at here. And we ended up finding that they had years of requirements on buildings, some of which that were being mistakenly flagged as the flood zone. Some of them weren't even in the flood zone technically, but the flood zone determination had flagged them. And so across 13 properties, we ended up finding just over $200,000 in savings for them. Now they're a national company, so I'm sure that like anyone, $200,000 can make quite a dramatic splash, in the bottom line. And, so this was a pretty substantial batting average, 13 out of 20 properties finding a solution. That's not uncommon. You'll see that just in our team, usually it's about 50% in properties that we look at across the country where there's some type of cost saving solution that's possible. So Hope this has been, quite educational. I went a few minutes over the half hour, so I apologize. I'm going to switch into the Q&A. So hopefully you can stick around for a few minutes. So let me dive into some of the first questions here. All right, so the first question was, can we assume a residential flood policy or only a commercial flood policy? For us, probably 90+% of projects that we are doing are commercial. So I see this more commonly as a strategy on the commercial side. But that being said, it should apply just the same in a residential situation if they have an NFIP policy and your broker is able to then assume coverage with the same carrier. So I definitely think if you're in a acquisition situation as a residential homeowner, I definitely think this is worth asking about. Second question also says, if we're in a flood zone X and get a policy, will we likely proceed at a lower rate if the flood map was modified, requiring us to get the policy? So I think his question is, if he was in a flood zone X and then he were to be switched to the 100-year flood zone, how is that going to affect his policy, and would he be grandfathered at the X zone pricing? It's a great question. So in the prior NFIP model, you would find that X zones had standard pricing. And so then even if the flood zone changed, you actually would still get that X zone pricing year one. Unfortunately, FEMA did away with that actually when they moved into risk rating 2.0. Now, that being said, if the prior policy still exists, now we encouraged a lot of this during the transition. If someone had an X zone policy, it was definitely worth keeping, because then as they sold the property, they could pass that lower price point from the old X zone pricing to a new buyer. But if you started at the old X zone pricing, look at what the full risk premium is on your renewal, because then you'll at least know how much you can expect increases to be year over year. This is the same for commercial or single family properties. So another question kind of along the lines of NFIP versus private policies. So NFIP, yes, their max increase is set at 18%. That could change. We've heard rumors that there's some talks of people trying to push a 9% to get that voted through on the political side. We don't know for a fact if that's going to happen yet. So we want to assume right now that it's 18% in the years to come. What are the benefits to going to a private policy? Well, you really have to talk to your broker and see what the differences may be. One of the things about private policies is that they're not capped at 500,000. So you will see scenarios in a lot of cases where if someone's flood insurance requirements are in excess of that of NFIP, maybe they need $1 million in coverage for that building, NFIP would only cover 500,000. In some cases, you'll see someone go straight to the private market to get that full $1 million covered. In other cases, we might see where someone gets NFIP for the first 500,000 and then gets a private policy to then cover whatever difference they're still required. So there's no right or wrong way. And a lot of times we're hearing where brokers were just evaluating, which of the two is going to be more cost effective. The one thing about private insurance is that you can be non-renewed at any renewal, right? You're not guaranteed to have that policy the next year. We have a condo client down in Fort Myers that was just non-renewed. They had a private policy where they're paying about $1,500 a building. I think it was across 10 buildings, and their private policy non-renewed them. NFIP, they were receiving quotes anywhere from $5,000 to $8,000 a building. Fortunately, they qualify for a MAP amendment. This was a situation that before they chose not to exercise because their other policies were so reasonable. Now being forced to start at the full risk premium at that $5,000 to $8,000 price point, they've decided that they may consider actually taking advantage of the MAP amendments. So again, it's not that one's better or worse than the other. They just have differences and different characteristics. So, again, huge proponent of just having these conversations with your broker so that way you can really understand. And if there's any questions, you can always involve our team. We get questions all the time. There's no cost for us to, have a conversation by any means. We're here to help educate. in every case that we can. Give me just 1 second to read this next question, please. So the next question was talking about someone that purchased a property in Zone A. And does NFE offer a service to analyze your property and review your current policy and premium to understand if anything can be approved? That's exactly what we do every day. And thank you for that question. Not that this webinar is about pitching us, but to give you just a little bit of visibility into our process, we look at hundreds of properties every month all over the country. There's no cost for us to evaluate and have our engineers look at any solution that may be possible. So that's a perfect example of what we're doing every day. We're going to look to see if a map amendment's possible. We're going to look and see, are there any engineering variables or details that are being used in the rating of the policy that can potentially lower that full risk or current premium. And we do this for, acquisition scenarios where you may not own the property yet. So we'll go through this process while someone's, looking to make an offer, or, we'll get a little bit deeper while they're in due diligence. Just the same for, current property owners. Question about the PDF of the presentation. Yes, we'll be sending out the slides and a recording of the presentation to follow. So this is a situation, someone's asking, how would you handle properties that were already taken out of the flood zone by a LOMA, no NFIP was previously placed, and then they're pulled back into the flood zone and another LOMA cannot be filed? This does happen from time to time. We don't see it on a high percentage of properties, but there have been some coastal flood maps around the country that have been updated a bit more conservatively than they had been in years past. And so we have seen some areas where a LOMA was done and was then invalidated by the new flood map. I would say in a lot of cases in my 5 years, I've not seen a dramatic number of these cases. In a lot of situations, FEMA is using the updated engineering information that we're providing as they're updating the flood map. But it can happen. And so, how would you handle that situation? If nothing can be done, then you're going to want to explore the best possible flood insurance options, because if it is back into an A or V flood zone, the lenders are required to pass on that requirement. So it is an unfortunate situation that there may not be other solutions for. Someone asked, as a broker, where would you say is the best place, best carriers to get quotes for NFIP? In theory, you should be able to go to any NFIP carrier. There are several, Right Flood, Selective, Assurant, National General. There's various more. They're all using the same risk rating 2.0 system. In theory, they should all get the same numbers. So there really shouldn't be a best or better place. I do think that there are carriers that have larger books of flood business. And so they do have, perhaps a larger service team, and you may get more help if needed from those particular carriers. But, in our experience, I wouldn't say that anyone's better or worse than another. A question about what type of land modifications are worth doing to improve the flood risk. So land development is something that, we've had more interest in the last several, I'd say 2 years specifically, than we've had in years past. As you see such a high demand for housing right now around, certain metro cities in the country, as they're spanning into the more tertiary markets, they're running into flood zones. So with land modifications, there are certain things you want to take into account. The first thing is understanding what's the current topography, meaning the elevations across the actual land, and how that compares to the flood elevation. If it's within something reasonable, now reasonable is relative, meaning how much dirt could possibly be brought in to elevate those buildings to where they might then be able to be removed from the flood zone. For all the land that you bring in, you also have to take it out somewhere else. So there's a net zero rule that exists for land development. This is why you see so many, different types of retention ponds across new properties. because you have to account for where the water is going to go. You cannot obviously bring a bunch of dirt in that may end up flooding all the neighbors around. So it's working with the drainage engineer to understand, all right, can we elevate these buildings? And in a lot of cases, this is something that we're also consulting with, giving this type of information and giving specifics as to what would need to be done so that a map amendment would be able to be processed and approved. And so that way you're building a property that at the certificate of occupancy wouldn't require flood insurance to be placed. Can't be done for every single case, but again, if the data is workable, then there's quite a few scenarios where you see this being done. Another really good question: how often is the full risk premium being reevaluated? And I think in my experience, what we've seen now, the full risk premium is still fairly new within the last 2 years, but typically once variables are input into a policy, the carriers are not generally reevaluating these every single year. Now, the full replacement cost value that's now being input, that will be updated or should be updated every couple of years. But aside from that, if there's not some reason that is, directing attention to that policy, there may not be something automatically that is then looking at that policy to see if the full risk can be evaluated. That's something that we do in every case that we look at. So it's part of our standard process. And again, this is why so many real estate and insurance brokers, have just made us just part of their team, just an extension of their resource. Because it's something that we can really give attention to while, these professionals are giving attention to the other areas of your property. And that's what I mean on the last few slides, where it really is a team effort. Another good question: can installing flood vents in a residential home help make my foundation conform and reduce my premium? Unfortunately, the flood vents have not had as high of a multiplier in the new rating system as they did previously. So in the old risk rating, in the old NFIP 1.0 system, flood vents would make quite a bit of a difference. It would allow the policy to the property to potentially be rated at the next floor, whereas risk rating 2.0 is not placed as high a multiplier. Now, from a flood mitigation standpoint, they are required from permitting with any new construction. My home has flood vents here in Tampa. So from an actual, flood mitigation, if we were to ever have a flood, I'm glad that we have them. But unfortunately, even for my particular home, they don't actually make much of a difference in the premium. Sorry, not a ton of good news on that one. Another good question here: how often are flood maps changed? I think I might have mentioned, in most areas of the country, it's around every 15 years. Some areas you may see as fast as every 10. The reason for this is that the local municipalities, the local counties, are the ones that actually oversee the maintenance of their flood maps. And so depending how much funding they're being directed at the flood map, and depending how often flooding is even an actual issue, you could imagine certain areas of the Gulf and certain coastal areas may give more attention more often. And so you may see flood maps, more updated more currently in those areas. But in general, if you see, for example, a letter of map amendment being processed, that LOMA is going to be valid for the life of the flood map. And part of our process is we check to see if the flood maps are actually being updated in those areas, as we're letting a client know that the LOMA is a possibility to pursue. Is that okay? If the flood map's only 2 years old, you can pretty much predict that LOMA is going to be valid for quite the next several years. Second part to this question is: are lenders now more frequently requiring insurance for properties in the 500-year floodplain and not just the 100? So really good question. This goes back to the misconceptions slide. Lenders don't have an opinion when it comes to the flood insurance. For them, it's a compliance piece. So if it's not in a 100-year flood zone, then legally, they're not going to require flood insurance. Now, that being said, if you're using any kind of private type lending, perhaps even a local bank that has like their own lending programs, In those situations, they may choose to require whatever they want. But for standard federal loan programs, they're only going to require the 100-year. Does NFIP give refunds if determined not to be in a flood zone? So yes, NFIP has a set of cancellation rules that they've updated to where now they will give you a prorated refund if for any reason you are deemed not to be in a 100-year flood zone any longer and are then canceling your policy. So this could be that the local flood map updates and you're no longer in a flood zone, letter of map amendments, or any type of map revision that then takes your property out of the flood zone. At that point, you'd need to have your lender update their flood zone determination document first. They'll then give a letter back saying that you're no longer required for flood insurance. Your insurance broker will need that letter in order to process the cancellation, and then you'll receive a prorated refund back as a result there. And then one last question. So if you have any more, please go ahead and drop them in. We still have just a couple more minutes. But a question about the 50% rule and how it's calculated for individual properties. This one can be a little tricky to explain, but the 50% rule in general is speaking that if a property is in a flood zone and you're choosing to do some type of improvements to the flood zone, improvements to the building, meaning you're maybe trying to do an addition, you're trying to do some substantial improvements. There are situations that if you're improving the value of the property by more than 50%, that it may require you to bring the building up to current permitting standards with the flood zone. And so there are situations where that may not be possible. And so I would say it's definitely worth looking to see if a map amendment can be done, because that actually will remove those requirements. And so, there's a lot of different benefits that come from a letter of map amendments. It's not always just about the insurance savings. Sometimes it's about making the property value as high as possible, making the property more marketable, perhaps making, in this case, a construction rehab, go a little smoother. But again, lots of benefits to seeing if that's possible. And then again, if you have a flood insurance premium, it's always worth having some professionals take a look at the details to see if there's anything that can be done to reduce that policy. And then one last question was, regarding lenders that get fined on loans for properties where there's no flood insurance in place. And that's correct. So there's the Flood Disaster Act of 1973, I believe. I always second guess the year when I say that. But what this essentially put in place was that lenders have to pass on a flood insurance requirement for anything in a 100-year. And then, as lending institutions are audited every so often. I've spoken to someone with Fannie Mae who every month they're auditing, a certain number of, Fannie Mae loan placements around the country. And so, yeah, if they find buildings that have not had flood insurance, placed on them, then at that point the lenders are issued a fine, and then obviously they're going to then pass down that requirement to you. But small little segue on this topic is that if a flood zone ever changes, or if your lender learns that one of your buildings is now in a 100-year and needs to have a flood insurance policy in place, you're going to receive a letter that says you have 45 days to provide proof of coverage. So if you've ever received one of those letters, definitely take them seriously, because if proof of coverage is not put in place, this is where you will see lenders force place flood coverage. And similarly, if you get a map amendment done, they will then drop the force place coverage. So give it just one more second. Are there any other questions that someone would like to drop in the Q&A? And then we'll finish up with just how you can get in contact with our team if you have any interest. Going once, going twice. All right, great. So we've got a couple QR codes here. I'll leave this up for just a second. If you'd like to schedule a call with one of our team, by all means, we'd love to talk to you. We're in the business of helping people. And so if we can help you in any way, whether that be just kind of pointing you in the right direction, giving you the right question to ask a seller. However we can help, we're happy to do it. You're going to receive a copy of our due diligence checklist, something that we put together to just give you a takeaway. You'll receive that by email in the follow-up. But if you want to go ahead and download that, there's a QR code for that right here. It's got just a checklist of things that you can go through and just use to help, as you're going through the buying process. And obviously, if you're sitting on the call and you're thinking, wow, I have a property that I would love for national flood experts to take a look at, you can also follow this QR code here. It'll take you to the form on our website, and that will then get one of our sales reps in contact with you quickly. Again, the property review is no cost, so you're not obligated to do anything. It's a free service that we offer to help, inform and, uncover solutions. And like I was saying, nearly 50% of cases. If you want to take your phone, you can just hover the camera over the QR code. If you've never used one of these, should pop up a little clickable link on your phone, and it will take you to that particular web page. I know QR codes were something that had some popularity years ago and are just now kind of making a comeback. But these will take you directly to the web page if you scan those with your camera. So again, I'll give you just one more second in case anyone wanted to use one of those. All right. And thank you. First and foremost, I appreciate you taking some time out of your day. I hope this was informative. I hope you learned something. Hope you have, a good takeaway, whether it help you with a current property that you own or one that you may acquire in the future. You're welcome to reach out to me. This is my email here, DJ@National Flood Experts. If you'd like to also have a property reviewed, you're also welcome to use this info@National Flood Experts email, or you can email your account executive that may have introduced you to the webinar today. Their email is the same format, first name @nationalfloodexperts.com. And obviously, we encourage you to go to our website. We just rebuilt our website this year. We've got a tremendous amount of information. There's a lot of case studies, a lot of video testimonials that we've recorded. So you can hear it firsthand from our clients, how their experience has been working with our team. And most importantly, what benefits they took away from their particular project. That refinance scenario that I talked about, you can find that on our In the Zone section of the website. So thank you again, and we look forward to working with you in the future.